Why does compounding feel like nothing is happening until suddenly it's explosive? The truth is, it's not that the math doesn't work, it's that your brain can't see the growth. Crossing the $100,000 line flips the script, because that's when your portfolio's returns begin to outpace your own contributions. In this video, I'll show you why early growth feels invisible, how to calculate your own crossover point, and the simple system that carried me past it. But before we get there, let's look at why the early stages often feel so slow, even when progress is happening underneath. Imagine putting money away month after month, watching each deposit land and still feeling like your balance barely shifts. For many investors, this is one of the most frustrating early experiences. It doesn't feel rational. You're saving, you're earning, yet the numbers look the same. The reason is that compounding hides a hidden phase at the start where growth exists, but the amounts are too small to register as meaningful. The math is running constantly in the background, but the progress doesn't shout at you yet. Think about an exponential curve. In the earliest stage, the line is almost flat. It rises so gently to the naked eye, yet nothing appears to change. That flat stretch is completely normal. It's how exponential growth always begins. The curve works in three parts: flat, flat, then steep. Your only job in the beginning is to stay on the flat part until it steepens. But here's the catch. Your contributions climb in a straight, steady line, while the compounding growth underneath is creeping quietly, almost invisible. If you were to zoom in mathematically, you'd see progress happening. In your account balance, though, it looks like very little. This is where psychology plays tricks. Logically, you can run the numbers and verify the interest is real. But because the amounts are small, your brain dismisses them as unimportant. For example, let's say you have $10,000 invested and earn 7% return. That's about $700 in a year. If you're contributing $500 a month, that $700 is nearly the same as just one extra deposit. It doesn't feel like much progress compared to your effort. But if you were sitting on $100,000, the same 7% return would generate $7,000 in a year. More than an entire year's worth of contributions for someone saving $500 a month. The math hasn't changed, only the base number has. And that shift in scale is what finally flips compounding from invisible to obvious. In the beginning, it feels like the system is failing you. Saving $6,000 or even $12,000 over a couple of years, only to see your growth total a few $100s, can feel disheartening. But this stage isn't failure, it's foundation. Think of it like a seed growing roots underneath. You can't see what's happening, but those roots are the only reason the plant can eventually break the soil and grow tall. Compounding works the same way. The early gains are the roots, stabilizing and preparing for what's to come later. Without sticking through this quiet phase, the dramatic growth phase never reaches you. And this is why many investors give up too soon. The challenge isn't usually that they made the wrong investment choice or earned poor returns. The challenge is patience. The illusion of stagnation convinces people to change strategies, pull out money, or stop altogether. When you can't see growth, it's tempting to assume nothing is happening. But in reality, the curve is doing exactly what the math dictates. It just hasn't crossed the level where your eyes recognize the impact. The truth is, what you feel in this early stage has little to do with the actual returns. It's about expectation. Compounding isn't disappointing you. Your perspective is. Refreshing your balance daily and waiting for big swings only sets you up for frustration. Understanding that the flat stage is not a mistake, but a necessary chapter is what separates investors who eventually build wealth from those who abandon the plan. So when does this shift happen? At what point does compounding stop whispering and start speaking loudly enough to grab your attention? That moment comes when the growth beats your own effort. When your portfolio generates more in a year than you contribute yourself. This milestone is called the crossover point. And once you reach it, the math finally becomes louder than your deposits, changing how you see the entire process. Now the question becomes, is that line at $100,000 for everyone? Or does the number look different depending on you? The real breakthrough in your investing journey comes at the crossover point, the moment your portfolio's growth finally beats your own deposits. Until then, it can feel like every step forward is powered by your effort alone. But once growth surpasses contributions, the balance shifts. Progress no longer depends entirely on your savings rate. It's fueled by the compounding engine itself. Here's what's happening beneath the surface. Before the crossover, you're the driver. The bulk of your portfolio's growth comes from your check hitting the account. But as your investments compound, there comes a point where the market contributes more than you did that year. At that moment, you feel the math doing the heavy lifting instead of your wallet. Now, the crossover point isn't universal. It depends on two factors: how much you invest each year and the returns your portfolio earns. This is why some people reach it earlier and others later. The $100,000 milestone gets attention because for many investors, especially those savings around $6,000 a year at average market returns, it lines up closely with that tipping point. But what really matters isn't chasing a round number, it's knowing your number. The simplest way to calculate it is with a straightforward formula. Take your annual contributions and divide them by your expected rate of return in decimal form. For example, contributing $6,000 annually and expecting a 7% return places your crossover at about $86,000. That's because 7% of $86,000 is roughly $6,000, the point where your portfolio produces what you add. If you're expecting closer to 10%, that crossover drops to around $60,000. And if your contributions are $12,000 a year with a 7% return, the crossover doesn't sit near $100,000 anymore. It lands closer to $171,000. The more you put in, the larger the number compounding has to surpass. You can picture this with two lines on a chart. One is the steady, straight line of your deposits. The other is the upward curving line of market growth. For years, your personal contributions sit higher, but eventually the growth line bends, intersects, and pulls ahead. That intersection is your crossover point, the exact place where compounding becomes the dominant force in building your wealth. And this is where psychology and math collide. Even though the returns are always proportional, the experience of them changes. Think about the rule of 72. Divide 72 by your expected annual return, and you'll know how long it takes for your money to double. At 7%, it's about a decade. If you start with $10,000, that means 10 years later you'll have $20,000. Useful, but easy to overlook. It feels like slow progress. But once your portfolio is at $100,000, doubling turns into $200,000 in the same time frame. That leap is hard to miss. The math hasn't changed, but the psychological impact is massive. Harry, an investor who went through this, felt it firsthand. For years, he watched his portfolio creep upwards by $20 here, $40 there. He often wondered if it was even worth it. But after crossing around $100,000, everything shifted. One morning, he logged in and saw that the market had added more than the deposit he had just contributed. That was his crossover point. For the first time, growth wasn't just supplementing his effort, it was surpassing it. What felt like dragging a heavy load turned into momentum, carrying him forward without the same strain. That's why the crossover matters. Not a finish line, it's more like the moment the engine switches on. After that, your job is less about pushing harder and more about keeping the system steady. Growth begins to pull its own weight, and you finally see the compounding you believe in becoming visible and motivating. Knowing your number is the first step. The challenge is actually reaching it as quickly and reliably as possible. So how do you set yourself up to hit that threshold without relying on sheer willpower? Here's a structured way to make that first $100,000 less overwhelming. A 5-step system designed to work in the background and steadily move you closer to your target. It's not about heroic discipline. It's about building a framework that runs whether you're paying attention or not. The first step is defining your crossover number. This transforms "one day I'll get there" into a clear target. To find it, take your annual contributions and divide them by your expected annual return. That gives you the exact portfolio size where compounding will overtake your own effort. The key is to make it visible. Write it down, pin it above your desk, tape it to your fridge, or save it to your phone. When you see that number often, each contribution starts to feel like real progress towards something tangible. What used to feel vague now feels like marching towards a finish line you can measure. Step 2 is simplifying your portfolio. Overcomplicating things with 5 different ETFs, a handful of mutual funds, and random stock picks creates noise, not progress. You don't win by having the fanciest collection. You win by staying invested. 1 or 2 broad market index funds gives you exposure to thousands of companies in a single purchase. If you want some extra stability, add a bond fund. That's it. Low fees, no guesswork, and it keeps you from chasing fads or second-guessing every move. The less energy you spend on what should I buy next, the more consistent your contributions become, and consistency is what compounds. Step 3 is automation. Even the smartest plan collapses if it relies on you making the right decision every payday. Automation pulls decision-making out of the process. Set up automatic contributions so money flows directly into your investments before you can spend it. Reinvest dividends automatically so nothing sits idle. And here's a trick that supercharges growth over time. Schedule a small increase in your contributions rate, just 1% or 2% every quarter. You hardly notice a difference in your monthly budget, but in a few years, that slow escalation can double what you're contributing, accelerating your crossover date dramatically. Step 4 is about accelerating early momentum. Because compounding feels weakest at the start, adding extra fuel makes the process feel alive sooner. This doesn't have to be dramatic. Maybe you cut out a recurring expense and funnel the savings into your account. Or you take a bonus or side income and put it straight towards your goal. Harry's result came not because he tried 10 hacks, but because he picked 2 strategies that genuinely moved the needle and stuck with them. By focusing instead of scattering effort, he made his first $100,000 feel inevitable. Your best results come from doing a few things really well and repeating them. Step 5 is protecting the engine. Momentum only matters if you don't break it. That means keeping an emergency fund so you never have to sell investments when the market dips. It means choosing tax-advantaged accounts when available, like a 401k, Roth IRA, traditional IRA, HSA, TFSA, or RRSP, so more of your money keeps compounding instead of leaking away. And it means aligning your portfolio with the level of risk you can stomach. If a 20% market drop would cause you to panic and pull out, your strategy isn't built to last. Compounding requires staying power, and that only happens if you can ride out the turbulence without interruption. These steps don't look flashy, but they're what make $100,000 feel attainable. They turn invisible growth into measurable progress, and they keep building even when you're not watching. But while a system can carry you forward, it's surprisingly easy to stall out by making unforced errors along the way. Many people slow their own progress without realizing it, and that's why getting past that first $100,000 feels harder than it has to. Some investors find themselves building steadily, while others stall out below 6 figures for years. The difference often comes down to a handful of repeated errors. There are 5 mistakes in particular that quietly undermine progress and keeps compounding from doing its full job. Avoiding them clears the path forward. The first mistake is chasing hot tips or trying to time the market. It feels exciting to jump into whatever stock or sector is buzzing, or to pull back when headlines shout bad news. The problem is that compounding rewards time in the market, not guessing when to be in or out. Each time you pull money in and out based on predictions, you interrupt growth. Even missing just a few of the best performing weeks can set you back thousands over the long haul. Hot tips are appealing because the stories sound big, but in practice, they derail the slow, steady progress that builds real wealth. The second mistake is over-slicing diversification. Many people assume that more funds equal better protection. On paper, holding 10 ETFs feels like spreading risk. But under the surface, many of those funds hold the same underlying companies. Instead of true diversification, you create overlap, noise, and complexity with little added benefit. Managing that many positions also increases the chance you'll second-guess yourself or get lost in the details. 2 or 3 broad, low-cost index funds already give you exposure to thousands of companies around the world. Beyond that, simplicity beats clutter. A streamlined setup makes it easier to stick with your plan and actually know what's happening with your money. Mistake number 3 is ignoring fees and taxes. This mistake is easy to overlook because the costs seem so small in the short term. A 1% annual fee doesn't sound like much, but stretched over 30 or 40 years, it can erase hundreds of thousands of potential dollars. The same holds true for taxes when you're not using accounts designed to shelter your returns. Using low-cost index funds and maxing out tax-advantaged accounts like a Roth IRA, 401k, TFSA, or RRSP before using taxable accounts locks in more of your growth. Compounding works best when you don't allow small, quiet drags like fees or taxes to pull at it every year. Fourth is panic selling during downturns. Markets will always have stretches where balances shrink quickly, sometimes by 20% or more. Without a plan, it's easy to let fear dictate your moves, selling low and locking in losses. But in reality, markets have historically rebounded, and much of long-term growth comes from those recovery periods. A written pre-commitment makes all the difference. Harry, the investor we talked about earlier, wrote down one rule during calm times. If my portfolio drops 20%, I keep buying the same amount. That single commitment meant he never had to make the decision amid panic again. He followed the rule once, and when volatility hit, the choice was already made. Putting rules like that in writing keeps fear from taking control at the exact moment patience matters most. The fifth mistake is misreading early, quiet growth as failure. During the early stages, your portfolio will look stagnant, even when the math beneath the surface is working. Many people get discouraged and quit right before the real acceleration begins. Remember the mental model? The curve is exponential. Flat, flat, then steep. The investor's job during the flat phase isn't to force growth. It's simply to stay on the curve until it steepens. Walking away too early means never experiencing that natural turning point where progress begins to move visibly and faster. Patience, not dramatic action, is what carries you through this stage. Avoiding these 5 mistakes doesn't just prevent setbacks, it clears the way for compounding to show its strength. Once the distractions and self-sabotage are removed, the growth already built into the system becomes visible and consistent. And it's that steady progress that eventually turns the first $100,000 from a distant idea into a realized milestone. Crossing $100,000 isn't about luck. It's the moment where steady savings finally meets visible momentum. Returns begin to outweigh your own deposits, and efforts shift into progress you can actually see. The math stays the same, but your experience of it changes entirely. Start now. Open your brokerage app, set up automatic contributions, and write down your crossover number. Drop that number in the comments. It makes the goal concrete and helps you stay accountable. Remember, Harry began with just 15 minutes on a Thursday. No perfect plan, just a start. This video is educational, not financial advice. Investing involves risk, including possible loss of principal. Do your own research or consult a professional before making decisions.